Welcome back to the ProTicker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
And honestly, if you haven't had your second cup of coffee yet, you might want to grab it.
Yeah, you're going to need it.
Because the headlines this morning, they're not just moving fast. They are effectively rewriting the entire rule book we've been operating under for the last few years.
It really does feel like a Monday where the weekend just decided to change the entire trajectory of the quarter.
Right.
I mean, we usually try to ease into these deep dives, maybe start with some earnings whispers or a CEO shuffle. But today
is heavy.
Yeah, we are looking at a collision of constitutional law, a reignited global trade war that just changed shape, and a high-stakes gamble in the AI sector.
A gamble that is making some very smart investors incredibly nervous.
Exactly. So to break this down, we are pulling sources from Bloomberg, CNBC, Yahoo Finance, and CNN. And the common thread running through all of this reporting is just instability.
It's a perfect storm. The market is trying to figure out which way is up right now. We've got this fundamental shift in market stability.
Going from trade policy uncertainty to this massive bond binge in big tech.
Right, a bond binge that is shattering all the unspoken rules with investors.
Let's start with the story that probably wrecked a lot of risk models this weekend. Looking at the reports from Yahoo Finance and CNBC regarding the Supreme Court.
Yeah, this was huge.
They didn't just issue a ruling. They effectively pulled the rug out from under the administration's trade policy.
Pulled the rug is putting it mildly, honestly. The Supreme Court ruled that President Trump did not have the authority to use the International Emergency Economic Powers Act.
That's IEEPA.
Right, IEPA. He can't use it to impose those broad global tariffs we've been living with because, just for context, IEPA is a tool meant for genuine national emergencies.
Right, like war or terrorist financing.
Imminent threats, exactly. The court essentially said, look, a trade deficit is annoying, but it is not a national emergency that justifies completely bypassing Congress.
And the practical effect of that was immediate. I was reading the CNBC piece, and it highlighted this massive whiplash.
Oh, the operational chaos was insane.
Customs and Border Protection actually stopped collecting the tariffs. Just stopped.
Yeah. As of 12:01 a.m. Tuesday, the collection mechanisms went offline, like a light switch flipped. For a few hours there, importers were bringing goods in duty-free.
You can just imagine the chaos at the ports. Companies scrambling to get goods cleared while the system was effectively down.
But that pause didn't last, and this is where the story gets legally fascinating. The president didn't just take the loss and move on.
No, of course not.
He immediately pivoted. And we have to get into the weeds of the Trade Act of 1974 here, specifically Section 122.
I saw Section 122 mentioned in the analysis, but how is it different from IEPA?
So when the Supreme Court took away the IEPA emergency hammer, the administration reached into the toolbox and pulled out a scalpel, but they're basically using it like a sledgehammer.
Okay, break that down for us.
Section 122 is specifically designed to deal with balance of payments deficits. It's an accounting mechanism. It's not a War Powers Act.
So it gives the president the authority to impose tariffs if the U.S. is hemorrhaging money to foreign markets.
Exactly. So almost immediately after the ruling, Trump cited the section to impose a new global tariff. He started at 10%, and then in a move that felt very much like a rapid-fire negotiation tactic, he bumped it to 15% almost instantly.
But why stop at 15%? I mean, if he wants to project strength after a court loss, why not go back to the higher rates we saw before the ruling?
Because Section 122 has handcuffs. The absolute legal ceiling under this statute is 15%. He literally cannot go a penny higher without Congress. And here's the other kicker. It has a timer.
Right, 150 days.
Yep. These tariffs are only valid for 150 days unless Congress steps in to extend them. So we went from an indefinite emergency tariff regime to a temporary capped tariff regime in the span of 24 hours.
That feels like a massive downgrade in leverage for the administration.
Yeah.
But simultaneously a massive headache for businesses.
Huge headache.
Because Yahoo Finance is highlighting what they call the refund question.
Yes, this is the number keeping Treasury officials awake right now. Because the Supreme Court ruled the previous IEPA tariffs were illegal, not just stopped, but legally invalid. There is a very strong argument that the U.S. government has to refund the money it collected.
And we aren't talking about small change here. The reports suggest over $100 billion might need to be refunded to importers.
Imagine the logistics of that. Importers who paid these tariffs years ago now lining up for checks. The government might be on the hook for a $100 billion injection of liquidity back into the corporate sector.
Which sounds great for those companies, but where does that money come from? And what does that do to inflation if you suddenly inject $100 billion into the economy?
That's the toxic uncertainty market strategists are warning about. It looks like a procedural reset on paper, but if the government fights the refunds, which they likely will, you have years of litigation.
Meanwhile, businesses have no idea if they're getting that windfall or if they just need to price in the new 15% levy immediately. It effectively freezes decision-making.
And freezing decision-making is the absolute last thing you want when you have a geopolitical summit on the calendar.
Right. Let's pivot to the geopolitics.
Yeah.
Because this is where the real-world impact hits.
Yeah.
We have the meeting between President Trump and Xi Jinping coming up in Beijing, scheduled for late March or early April.
The timing could not be worse for the White House. CNN and CNBC are both pointing out that the administration wanted to walk into Beijing holding a baseball bat.
And the IEPA tariffs were that bad.
Exactly. But now they're walking in with a Section 122 stopwatch that runs out in 150 days. The Supreme Court effectively clipped Trump's wings, which is a direct quote from a former trade rep in the source material.
There was a really specific detail in the Bloomberg report about this shift in power dynamics that caught my eye. They called it the soybean card.
Yes.
I remember the soybean purchases being a huge part of the Phase 1 deal years ago. Are we really back to that?
We are, but the context has completely flipped. China had committed to buying 25 million tons of soybeans. But, and this is the crucial part, that contract was predicated on the old tariff threats.
So it was a quid pro quo. You hold off the tariffs, we buy the beans.
Precisely. So if the tariffs are declared illegal,
Then the contract condition is void.
Bloomberg points out that China now has the soybean card back in their hand. They can say, well, the legal basis for our purchase agreement is gone. We are pausing the soybean buys until we see what happens with this new Section 122 nonsense.
Wow.
It gives Beijing a massive opening to renegotiate or just apply pain to U.S. farmers right before the summit.
And it's not just China watching this. The global fallout seems fairly widespread. CNBC is reporting that the EU and the UK are sounding the alarm.
It's everywhere. Because their concern is that existing trade deals were built on the foundation of avoiding those specific IEPA tariffs.
Right. If the U.S. policy foundation crumbles, the deals sitting on top of it look shaky.
Exactly. We're seeing a situation where allies are just as nervous as rivals. India and Brazil are also seeing lower effective rates temporarily, but nobody knows if their specific carve-outs apply to the new Section 122 rules. The confusion is making everyone nervous.
So we have legal chaos, a $100 billion refund liability, and geopolitical leverage evaporating. I assume the markets took this well.
If by, well, you mean a sea of red, then yes.
Yeah, I'm looking at the numbers here. Futures are sliding. Dow is down 0.5%, NASDAQ down 0.7%. But the thing that really stood out to me in the Bloomberg report was the crypto reaction.
The Bitcoin drop?
Yeah, dropping below $65,000. For years, people have argued that crypto is a safe haven when government macro policy gets messy.
This is a really important moment for the crypto as digital gold thesis. The government just messed up significantly, causing macro chaos, and Bitcoin is tanking. It is fragile right now.
But why? If the dollar is facing uncertainty, shouldn't people be fleeing to alternative currencies?
In theory, yes. But in practice, Bitcoin is reacting to macro uncertainty and this tariff whiplash by behaving like a risk asset, like a high-growth tech stock.
So they dump the risky stuff first.
Exactly. They aren't treating Bitcoin as a bunker. They're treating it as a speculative bet that they need to liquidate to raise cash.
But they are buying actual gold. That's the contrast Bloomberg highlights. Gold is up 1.4%, trading near $5,180 an ounce.
That is the traditional, boring, effective flight to safety. When the world looks wobbly, investors treat gold as the ultimate safe haven against the weaker dollar and trade instability. The big institutional money still trusts the shiny metal over the digital code.
Let's look at the bond market, because usually that's where the smart money hides. Bloomberg is reporting that Treasury yields are bouncing off the key 4% level.
Right.
If stocks are down, shouldn't yields be dropping as people buy bonds?
You would think so, but the bond market is sniffing out inflation. This goes back to Section 122. Even though the tariff rate is capped at 15%, the uncertainty about supply chains, combined with a labor market that is still surprisingly resilient, has traders worried.
Worried about Fed rate hikes.
Yes. If tariffs push prices up, the Fed has to keep rates high. That bearish shift is keeping a lot of pressure on bonds right now.
So we have a macro environment that is hostile to risk, hostile to bonds, and confusing for trade. And yet, This brings us to the second massive story of the day. In the middle of all this, big tech is doing something that seems almost counterintuitive.
It's the AI bond binge. While the macroeconomy is flashing warning signs, Silicon Valley is doubling down.
We're seeing this reporting from CNBC about tech companies breaking this unspoken contract with investors. Explain that to me, because I thought the rule was always that cash is for boring stuff and equity is for risky stuff.
That was the rule. For the last 20 years, if a tech company wanted to fund wild experiments like self-driving cars or VR goggles, they paid for it with their own cash piles or they issued stock.
Right.
You don't take out a loan to go to the casino. You bet with your own winnings.
But now, the new reality is completely different. Oracle and Alphabet are issuing massive debt.
Massive debt. Alphabet just issued $20 billion in debt.
And within that debt issuance, there was one financial instrument that caught my eye. A 100-year sterling bond.
A century bond. Think about the timeline there. Alphabet is asking investors to lend the money today to be repaid 100 years from now.
Who buys that?
Yeah.
Seriously, who looks at the world today and says, yes, I will lock up my capital for 100 years with Google?
It's a very specific type of bet. Pension funds and insurers buy these because they have liabilities that stretch out decades.
No, interesting.
But for Alphabet, it is basically a creditworthiness issue now. They're locking in capital to build infrastructure today, but CNBC points out that Alphabet's CapEx is hitting nearly 50% of its revenue.
50%?
Yes. They are pouring this borrowed money into physical data centers filled with AI chips. But the rate of AI advancement is so fast.
Which brings up the obsolescence risk. The CNBC report quotes Al Cattermole from Mirabaud Asset Management, and he raises a really scary point.
It's the core danger. He calls it a break point in natural cycles.
Right, because investors fear that by the time these debt-funded data centers are built, which takes, what, maybe 3 years?
At least 3 years. And by the time you cut the ribbon, the chips inside are completely outdated.
So the collateral could be worthless.
Exactly. You are financing a 100-year liability with an asset that has a useful life of maybe 3 years. If the revenue from AI doesn't materialize fast enough to cover the turnover of that hardware, these AAA-rated tech giants suddenly look a lot more fragile.
That is a massive mismatch. And it's not just the financial cost. We have to talk about the physical, environmental cost, too. There is a brewing war over resources that's starting to hit the headlines.
This brings us to Sam Altman from OpenAI. CNBC covered his recent comments where he's taking a very aggressive defensive stance on this.
He called the concerns about data center water usage fake and totally insane.
He did. He's trying to get ahead of the narrative that AI is an environmental drain, but the specific comparison he used to defend AI energy consumption was definitely provocative.
He compared it to humans, right?
Yeah.
Arguing that humans also use energy to learn.
Yes. His specific claim was that training a human takes 20 years of life and all the food you eat before that time.
I mean, strictly speaking, humans do consume energy, but comparing human biological growth to a gigawatt-scale data center.
Sridhar Vembu from Zoho Corp jumped on this immediately. He called it an unfair equivalence because a data center draining a local aquifer to cool servers is an industrial strain on the grid. It's a resource extraction issue, not just a learning issue.
And it seems like investors are starting to pick sides, or at least rotate their money based on these fears. Yahoo Finance has a report on the AI scare trade.
Yeah, this connects back to the broader tech weakness. We're seeing money moving out of software and tech overall. Software is down 23% year to date.
And moving into catch-up sectors. But why?
The market is fearing AI will replace enterprise software. It's a rotation out of tech stocks despite all the AI hype. Investors believe the AI that big tech is building with all that debt is going to replace the need for traditional software companies.
So the market is fearing big tech is borrowing money to build the exact thing that kills the rest of the tech sector.
Exactly.
So let's try to pull these two massive threads together for our listener, because they are definitely not happening in isolation.
No, they are crashing right into each other.
On one side, we have this constitutional clash and a trade war whiplash. The new tariffs, the retaliation from China, it all creates a world where hardware and raw materials become more expensive and volatile.
Right. The cost of the physical stuff to build these data centers is going up.
And on the other side, right at the moment, big tech is taking on historic debt to build hardware that might be obsolete in 3 years. So my final provocative thought for you to consider today is this. Are we looking at a credit bubble popping in the middle of a trade war?
If the trade war delays the data centers or makes the chips more expensive, does the math on those 100-year bonds still work? It's a brilliant question.
A credit bubble popping in the middle of a trade war. It's a sobering image, but it's the lens you need when looking at the market today. We'll see you all tomorrow morning with new headlines from major financial magazines.